What's going on, everybody? Q here from Hyperstocks. Thank you so much for checking in. In this video, we're going to go over the most recent US GDP Q2 report from 2022, and then we're going to talk about how this will impact the stock market and key levels to pay attention to. Now, most people that saw the report today and played the market did realize that the market went up unexpectedly. It actually rallied all day, and it has been rallying all week, which is very unexpected during a time of a recession. We're going to talk about why it rallied and where it could reverse back down. So without further ado, let's go ahead and get started by breaking down the US GDP report for the second quarter, where we can see that we contracted for back-to-back quarters. So what does this mean for us as an economy? It simply means that we are in a recession. A lot of people will argue against it, especially the people in the government, because they're trying to save face. However, in definition, we are definitely in a recession, but it may not be as bad as it seems. You got to remember that when the Federal Reserve started to raise rates in the beginning of this year, their entire idea was to cause a slowdown in spending, which typically may result in a recession. It is ordinary to see a slowdown in spending, especially after a rapid period of expansion. From 2020 to the end of 2021, we saw a rapid growth. In fact, in Q4 of 2021, we saw a growth of 6.9% on our GDP. So right now, as interest rates are going up, which makes borrowing money more expensive, people are no longer spending that much money. In fact, they're taking that money and they're spending it elsewhere. What contracted significantly on our GDP was the change in private inventories, which I'm going to break down in just a second. Now, let's take a look at where most of the money went in our GDP. A lot of people stopped spending money on durable goods and they started spending money on food services, healthcare, recreation, and transportation. This simply means that people are finally happy to get out of the house and they're starting to spend their money on leisure activities. But during this transition, they stopped buying durable goods. Durable goods are things like your TVs, your fridges, anything that you buy, and it's usually a large item and you hold on to it for a long time. What this does is it creates a surplus of private inventories in companies like your Walmarts and your Targets. So when that inventory is not moving, it actually becomes more of a liability and it eats into our GDP as a country. And you can see that was our largest contraction in the second quarter. What does this mean for us as an economy? Now, historically speaking, during times of a recession, we saw the change in private inventories actually dip into the negative. You can see that happen in 2008, and right now we're starting to move back into that negative territory. So looking forward at Q3 and Q4, we really want to keep an eye on change in private inventories. We want to see if people are still not spending money on durable goods. You got to remember that durable goods are very expensive items, and people right now do not want to spend on credit. They don't even want to lease. They don't want to do anything that has to do with interest because interest rates are going up, which is also hurting the housing market in general. So spending overall has gone down. We're seeing people refusing to use their credit card to buy those durable goods. In fact, people are using their credit cards more than ever to actually sustain day-to-day life. So that is something to keep in mind. Recessions slowly unravel themselves and they can get a lot worse before we know it. So it is important to keep in mind on the GDP growth in the next quarter and the following quarter. Two back-to-back small contractions may not be too strong of an indicator that we are poorly performing as an economy. In fact, we are still doing well as an economy. If we look at our unemployment rate, which is another measure of a recession, we're still only at 3.6% and we still have 11 million jobs available. Now, we did see a ton of companies begin to freeze hiring and they also started laying people off. So that's also another factor to pay attention to in the coming quarters. If we start seeing month-over-month increases in unemployment and more people filing for unemployment, then we can start to worry about more people getting laid off the workforce, which will slow down spending even more, which will cause a further contraction in our GDP. So there's a lot more to look forward to. The second quarter of 2022 was expected to slow down. Anytime interest rates go up, we are expecting a slowdown in spending, especially after such a strong period of expansion. So what does this all mean for the stock market? For the purposes of our video, we're going to use the SPY index or the ETF of the S&P 500, which is going to show that the daily candle has moved back above its 10, 20, and 50-day moving averages. This is something that we haven't done since March. So funny thing is, March 2022 is the time in which the Feds raised interest rates for the second time of this year. And we can see that after that federal meeting, we rallied for 2 weeks straight. So sometimes what you're expecting to happen doesn't happen on the stock market. And the simple reason to that is the stock market is not an exact reflection of news headlines and economic reports. As we said earlier, the stock market is a product of the economy. It is not the economy. And oftentimes the market will react to things ahead of the actual occurrence. So when we dropped in the end of June and we continued to drop in the beginning of July, that was a time in which the market was actually preparing itself for what was coming in the coming weeks. And we knew that we were going to have an array of earnings in which did not meet expectations, which we saw multiple earnings miss. We also were expecting the negative GDP report, and we were already expecting the rate hike. Therefore, the market had already priced itself in. So by the time when the news came to be, we had already priced our way in and we started to recover. What the market can do from here is it can potentially continue its rally, and there are key levels in which it needs to move above in order for this rally to become more of a bullish reversal than just a bear market rally. First level that has to be focused on is going to be above 417.50, which is where this leg up went, and we can see that we sold off significantly after it. This leg up represents the first major resistance that the market will need to move above in order to start potentially moving into a bullish trend again. After moving above 417.50, the market will move above 430, and that's the next level it needs to move up above in order for it to start consolidating and then potentially pushing its way towards 461 and 50 cents. If the market can break back above this level, which is the first leg after March rally, then the market can potentially move its way into full-on bullish reversal. At that point, the market will be back above its 10, 20, 50, 100, and 200-day moving averages, and you can potentially use those as your support points if you are looking to take on any positions. Now, if you are a bear, you do have a lot of room to run to the downside. The market can come down all the way to 370, but it will need to move below the 400 level. If the market maintains above the 400 level, that will always be a psychological support. Most traders will refuse to let go of their positions in the market as long as it remains above 400. So after the market breaks 400, the next support would be 390. Below 390, we will likely free fall down to 370, even lower if the market reacts more negatively in the future. Alright guys, so that's it. Thank you so much for joining. I appreciate you guys taking the time. Please don't forget to subscribe and give us a thumbs up.